This briefing is for accountants, bookkeepers, and tax professionals who are already using AI or are under pressure to use it, but who have not yet formalized governance around it. If you are responsible for decisions, reviews, or sign-offs, this briefing is for you. This briefing exists because artificial intelligence is entering professional practices faster than professional standards are being defined. In accounting, bookkeeping, and tax work, this creates a quiet but significant risk. Not because AI is inherently dangerous, not because technology is moving too quickly, but because governance is often introduced after adoption instead of before it. Most firms do not deliberately decide to operate without standards. They drift into it. A tool is tested. An output looks reasonable. Time is saved. Confidence grows. Gradually, AI moves from experimentation into production work, often without a clear moment where responsibility, boundaries, or judgment standards were formally established. That is where exposure begins. In professional services, the largest failures associated with AI are not technical failures, they are managerial failures. They occur when responsibility is assumed rather than assigned, judgment is implied rather than documented, and accountability is diffused across systems instead of anchored to people. When issues surface later, during a client challenge, a peer review, an audit, or a regulatory inquiry, the firm is often forced to explain decisions that were never governed in the first place. At that point, governance is being retrofitted after the fact. Retrofit governance is always weaker. It lacks clarity, it lacks consistency, and most importantly, it lacks credibility. This briefing exists to prevent that outcome. It is designed to help you establish standards before reliance, not explanations after problems. This is not a technical training. It will not teach you how to prompt AI. It will not compare software tools. It will not recommend platforms, vendors, or workflows. Those topics change constantly. Standards do not. This is a governance briefing, the kind of briefing that would normally take place inside a firm's leadership or risk management function, not inside a marketing presentation. The focus is professional judgment. In regulated and quasi-regulated professions, judgment is not optional. It is the foundation of trust. Clients rely on it. Regulators expect it. Courts assume it exists, even when it is not explicitly documented. AI challenges judgment not by replacing it outright, but by blurring the line between assistance and authority. When outputs are generated quickly, plausibly, and confidently, the temptation is to treat them as neutral inputs. They are not. They shape thinking. They influence decisions. They frame conclusions. That influence must be governed. This briefing starts from a simple premise. AI may assist professional work, but it must never replace professional responsibility. Responsibility does not belong to systems. It belongs to people. That principle guides every section that follows. We will define what constitutes an AI agent in a professional context because vague language produces weak control. We will establish why purpose and boundaries must be defined before expansion, not after. We will examine decision standards, when AI may be used, when it must not be used, and where judgment is non-delegable. We will address human-in-the-loop governance because accountability cannot be automated. We will discuss output quality, review discipline, data exposure, failure handling, and scaling with restraint. Finally, we will address how AI use should be measured and communicated, calmly, credibly, and without exaggeration. Throughout this briefing, the emphasis is not efficiency, it is defensibility. The question you should be able to answer at the end of this briefing is not, how much faster can my firm work with AI? The question is, years from now, can I clearly explain how AI was governed, reviewed, and constrained within my professional responsibility? If the answer is yes, then AI strengthens your practice. If the answer is unclear, then risk already exists, whether it is visible or not. This briefing is about restoring clarity, not by resisting technology, not by over-engineering controls, but by applying the same discipline to AI that has always governed professional judgment. Standards first, tools second. That is where governance begins. Before governance can exist, language must be precise. In professional services, unclear language is not a minor issue. It is a risk amplifier. When firms use the term AI loosely, they unintentionally collapse very different tools into a single category. That collapse makes it impossible to apply consistent standards, assign responsibility correctly, or explain decisions later. This chapter exists to establish a shared professional definition of what we mean by an AI agent, and just as importantly, what we do not mean. Not everything that uses technology is an AI agent. A calculator is not an AI agent. A spreadsheet formula is not an AI agent. Rule-based automation that executes fixed instructions is not an AI agent. Those tools behave deterministically. Given the same inputs, they produce the same outputs. They do not infer, they do not generalize, they do not suggest. AI agents are fundamentally different in a professional context. An AI agent is a system that receives inputs, applies probabilistic or inferential reasoning, and generates outputs that may influence decisions. That final element, influence, is the dividing line. Influence introduces accountability. The moment a system's output shapes how a professional thinks, decides, or explains an outcome, that system is no longer merely operational. It becomes decision adjacent. Decision adjacency is where governance begins. This matters because professional responsibility cannot be delegated. AI agents do not decide in the legal or ethical sense, but they frame options. They surface interpretations. They shape conclusions. When firms fail to recognize this distinction, AI systems are treated casually, even when their influence is significant. Outputs are accepted because they sound reasonable. Assumptions go unchallenged because they are presented confidently. Judgment is subtly deferred rather than explicitly exercised. None of this is intentional. It happens because language is imprecise. If everything is called a tool, nothing is governed correctly. This briefing deliberately uses the term AI agent to describe systems that generate interpretive or advisory outputs, even if they are marketed as assistants, co-pilots, or helpers. Marketing language is not a governance standard. Professional standards require functional definitions, not branding. An AI agent does not need autonomy to introduce risk. It does not need to execute actions on its own. It only needs to influence reasoning. That influence may be subtle. It may take the form of summaries, draft explanations, suggested classifications, preliminary interpretations, but once influence exists, accountability must follow. This is where many firms encounter difficulty. They attempt to govern AI usage based on intent rather than effect. The intent may be assistance. The effect is influence. Governance must be based on effect. If a system's output could later be questioned by a client, reviewer, regulator, or court, then it must be governed as part of professional judgment. This does not mean AI agents are forbidden. It means they must be contextualized. They must be clearly positioned as inputs, not conclusions. They must exist within defined boundaries. And they must never be mistaken for authority. Authority resides with licensed professionals, not systems. This distinction is essential for audit reconstruction. When work is reviewed after the fact, reviewers do not ask whether AI was used. They ask who exercised judgment, what standards applied, how were decisions reached, and who is accountable. If an AI agent influenced an outcome, but its role cannot be clearly articulated, governance has already failed. That failure may not surface immediately. It often appears later, when memories fade, staff change, and documentation is incomplete. By then, the firm is reconstructing reasoning instead of explaining standards. This chapter establishes the foundation for everything that follows. By defining AI agents as decision-adjacent systems, we create a consistent basis for governance. We can then ask the right questions. What is this system allowed to influence? Where must human judgment intervene? How is review conducted? And how is responsibility preserved? Without this definition, those questions cannot be answered consistently. Professional discipline begins with clarity. Clarity begins with language. If AI is treated as just another tool, it will be governed like one. If AI is recognized as a system that influences judgment, it will be governed accordingly. That choice determines whether AI strengthens professional practice or quietly undermines it. This chapter does not tell you what to adopt. It tells you how to classify what you adopt. Classification precedes control. Control precedes trust. And trust is the foundation of professional work. Governance begins before adoption. That is not a philosophical statement. It is a practical one. Most problems associated with AI in professional practices do not arise because a system malfunctioned. They arise because its purpose was never clearly defined and its boundaries were never explicitly set. When purpose is vague, expansion is inevitable. When boundaries are absent, drift becomes invisible. This chapter exists to prevent that drift. In a professional services environment, every AI agent must be assigned a single, clearly articulated purpose, not a general benefit, not a productivity aspiration, a specific documented function. Purpose answers one fundamental question: what is this system allowed to assist with? If that question cannot be answered in one clear sentence, governance has already failed. Ambiguity is not flexibility. It is risk disguised as convenience. AI systems are particularly prone to quiet expansion because they appear capable. They generate useful outputs in one context, and it becomes tempting to apply them elsewhere. A system introduced to summarize information begins to suggest classifications. A system introduced to draft language begins to influence conclusions. A system introduced to assist research begins to shape recommendations. None of this is intentional. It happens because capability invites reuse. Without defined purpose, reuse becomes normalized. Without boundaries, normalization becomes dependency. Dependency without governance is exposure. Professional standards require restraint. A single-purpose standard is not limiting, it is protective. It ensures that every use of the system is intentional, reviewable, and defensible. Boundaries exist to answer a second question: where must this system stop? Boundaries are not technical restrictions. They are professional constraints. They define what the system may not influence, which types of decisions are excluded, and when human judgment is mandatory. Without boundaries, discretion is left to individuals. Discretion produces inconsistency. Inconsistency is the enemy of governance. One professional uses the system cautiously. Another relies on it heavily. A third assumes it is authoritative. The firm now has multiple standards without realizing it. That fragmentation is rarely visible until work is reviewed collectively. By then, the firm is explaining behavior instead of pointing to standards. Boundaries create uniformity. They ensure that AI use is not dependent on individual comfort levels, technical familiarity, or personal judgment style. Instead, AI use is governed by firm-level decisions. This distinction matters. Regulators and reviewers do not assess whether individual staff members acted reasonably. They assess whether the firm exercised control. Control cannot exist if purpose and boundaries are undefined. Multi-purpose AI agents are particularly risky in professional environments. They blur accountability because no one can confidently state why the system was used in that instance, whether that use was intended or whether it exceeded its original scope. The broader the purpose, the weaker the control. That is why governance favors narrow definitions. Expansion should occur only after performance is understood, risks are identified, and controls are proven effective. Purpose must precede expansion. Boundaries must be reinforced continuously. This does not mean AI cannot evolve within a firm. It means evolution must be deliberate. Each new use case requires reconsideration of responsibility, review standards, and exposure. Without that reconsideration, expansion is accidental. Accidental expansion is indistinguishable from negligence when reviewed later. This chapter is not about limiting innovation. It is about preserving clarity. When a firm can clearly articulate what a system was designed to do, where it was permitted to operate, and why it was not used elsewhere, it demonstrates foresight. Foresight is interpreted as professionalism. Lack of foresight is interpreted as lack of care. Purpose and boundaries are not administrative formalities. They are signals of leadership. They show that technology adoption was intentional, controlled, and aligned with professional responsibility. This chapter establishes a discipline that will support every section that follows. Without purpose, standards collapse. Without boundaries, control erodes. Governance begins when both are defined and enforced. In professional services, discretion without standards is not flexibility. It is exposure. Decision standards exist to prevent uncertainty from becoming risk. When AI is introduced into accounting, bookkeeping, and tax work, the most important governance question is not how accurate the system is. The question is when it is appropriate to rely on it at all. Many firms approach AI adoption from the wrong direction. They begin by asking what the system can do. Governance begins by asking what the system should not do. This chapter exists to establish that discipline. Decision standards define 3 essential boundaries: when AI may be used, when AI must not be used, and when human judgment is non-delegable. Without these standards, AI use becomes situational, inconsistent, and impossible to defend later. Consistency is not a technical requirement. It is a professional requirement. If 2 professionals use the same system differently under similar circumstances, the firm no longer has a standard. It has opinions. Opinions are not defensible. Standards are. The first decision standard addresses permitted use. AI may be used where its role is clearly supportive and where its influence can be reviewed without ambiguity. This typically includes tasks such as organizing information, summarizing known material, or assisting with preliminary analysis. In these situations, AI functions as an input generator, not a conclusion maker. The second decision standard addresses prohibited use. AI must not be used where professional judgment is the primary safeguard. This includes situations involving final determinations, interpretations that rely on nuanced facts, or conclusions that carry regulatory or legal weight. When outcomes depend on professional reasoning, AI assistance must stop short of decision-making. The third decision standard addresses non-delegable judgment. There are areas of practice where judgment is inseparable from responsibility. In those areas, AI may inform but must never decide. This distinction is critical because AI systems do not understand accountability. They do not bear consequences. They do not respond to scrutiny. Professionals do. The danger is not that AI replaces judgment outright. The danger is that judgment is quietly deferred. Outputs are accepted because they appear reasonable. Time pressure encourages reliance. Confidence in the system grows. Over time, review becomes cursory. At that point, the system is no longer assisting judgment. It is shaping it. Governance exists to interrupt that drift. Decision standards create pause. They force the professional to ask, is this an appropriate use of AI? Is judgment still being exercised? Would I reach the same conclusion without this output? If the answer is unclear, reliance is already too high. Decision standards must be explicit. They cannot rely on individual intuition or comfort levels. One professional's caution is another's confidence. Without firm-wide standards, AI use becomes uneven and unpredictable. That unpredictability is not visible in day-to-day work. It becomes visible during review. Reviewers do not ask whether AI was helpful. They ask whether judgment was exercised. If a firm cannot articulate its decision standards, it cannot demonstrate control. That absence is often interpreted as a lack of governance. Decision standards also protect professionals internally. They remove ambiguity about what is expected. They reduce pressure to rely on AI simply because it is available. They provide a legitimate basis to say, this is not an appropriate use. That clarity preserves professional independence. Standards do not slow work. They prevent rework, defensiveness, and retrospective justification. Most importantly, decision standards make judgment visible. They show that AI did not replace thinking. It supported it within defined limits. This chapter reinforces a fundamental principle. AI may assist professional work, but it must never substitute for professional responsibility. Responsibility cannot be automated. It must be exercised, documented, and defended. Decision standards are how that responsibility is preserved. In professional practice, accountability cannot be delegated. No matter how advanced the system becomes, responsibility remains human. This chapter exists to reinforce that principle, because it is the point at which many governance frameworks quietly fail. Human-in-the-loop governance is often misunderstood. It is not about checking a box. It is not about adding friction. It is not about approving outputs after the fact. It is about preserving visible, traceable responsibility. In accounting, bookkeeping, and tax work, responsibility is inseparable from judgment. Judgment is exercised by people, not systems. AI agents may generate outputs, but they cannot be accountable for outcomes. They do not sign engagement letters. They do not answer regulator inquiries. They do not explain decisions years later. Professionals do. Human-in-the-loop governance exists to ensure that responsibility remains anchored to identifiable individuals at every point where AI influences work. This requires more than review. It requires ownership. Ownership answers a simple question: who is responsible for the decision that followed this output? If that question cannot be answered immediately and consistently, governance has already failed. One of the most common misconceptions is that review alone is sufficient. It is not. Review without authority is cosmetic. True human-in-the-loop governance requires three elements: review, override authority, and traceability. Review means the output is actively assessed, not passively accepted. Assessment involves questioning whether the output makes sense in context, whether it aligns with known facts, and whether it fits within professional standards. Override authority means the reviewer has both the power and the expectation to reject or modify the output. If rejection is discouraged, implicitly or explicitly, then review is not real. Override authority must be cultural as well as procedural. Traceability ensures that responsibility does not disappear over time. It must be possible to reconstruct who reviewed the output, when the review occurred, what decision was made, and who approved that decision. Traceability is not about surveillance. It is about reconstruction. In professional work, issues rarely surface immediately. They appear later, when memories fade and personnel change. If responsibility cannot be reconstructed, explanations become speculative. Speculation undermines credibility. Human-in-the-loop governance also requires that responsibility is not diffused. When everyone is involved, no one is accountable. Clear assignment matters. The person who reviews must be identifiable. The person who approves must be identifiable. The person who owns the outcome must be identifiable. This clarity protects both the firm and the professional. It prevents situations where staff assume oversight exists when it does not. It also prevents senior professionals from being surprised by decisions they did not realize were influenced by AI. Surprise is a governance failure. Effective human-in-the-loop governance makes influence visible. It ensures that AI assistance does not bypass professional hierarchy or judgment checkpoints. This is particularly important in environments where work is delegated. AI outputs can move quickly through workflows. Without defined checkpoints, they may reach finalization without meaningful scrutiny. Speed without control is not efficiency. It is exposure. Human-in-the-loop governance does not require that every output be reviewed at the same level. It requires that review standards match risk. Low-risk assistance may require lighter review. High-risk influence requires senior oversight. The key is that review expectations are defined in advance. Undefined review is discretionary review. Discretionary review becomes inconsistent review. Inconsistency is indefensible. Human-in-the-loop governance also protects professional independence. It reinforces that AI outputs are inputs, not instructions. Professionals remain free and obligated to disagree. That disagreement is not a failure. It is evidence of judgment. In well-governed environments, rejecting an AI output is not an exception. It is expected. Governance fails when professionals feel compelled to accept outputs because they appear authoritative. Authority does not belong to systems. It belongs to professionals. This chapter reinforces a central truth. If accountability cannot be clearly assigned, it does not exist. Human-in-the-loop governance ensures that responsibility remains visible, defensible, and professional. Without it, AI assistance quietly erodes judgment. With it, AI remains a control support, not an unexamined authority. In professional services, not every correct answer is acceptable. That distinction is often misunderstood, and it becomes especially important when AI is introduced into professional workflows. Accuracy alone is not the standard. Suitability is. This chapter exists to clarify the difference between verification and professional review, and to explain why that difference sits at the core of defensible AI governance. Verification asks a narrow question. Is the output technically correct? Professional review asks a broader one. Is this output appropriate to rely on, communicate, or embed within professional work? Those are not the same question. An output may be factually accurate and still be unsuitable. It may be incomplete. It may lack necessary context. It may oversimplify nuance. It may fail to account for specific client circumstances. AI systems are particularly good at producing outputs that appear polished and confident. That appearance can create a false sense of reliability. Professional review exists to counterbalance that effect. Review is not about mistrust. It is about responsibility. In accounting, bookkeeping, and tax work, outputs are rarely used in isolation. They inform decisions. They shape explanations. They influence conclusions. Once an output influences reasoning, its quality must be assessed through a professional lens. That lens considers not only correctness, but also relevance, completeness, and defensibility. Defensibility is the operative word. A professionally acceptable output is one that the reviewer would be prepared to explain, justify, and stand behind if questioned later. If an output cannot be explained clearly, it should not be used. If it cannot be defended calmly, it should not be relied upon. Review discipline exists to make that determination explicit rather than assumed. One of the most common governance failures occurs when review becomes superficial. The output looks reasonable. The language is coherent. The conclusion aligns with expectations. As a result, review becomes confirmation rather than evaluation. At that point, professional judgment is no longer being exercised. It is being deferred. This is rarely intentional. It happens because AI outputs reduce friction. They save time. They feel complete. Governance exists to slow the moment of acceptance, just enough to ensure judgment is applied. Professional review must ask uncomfortable questions. What assumptions does this output rely on? What facts were not considered? What uncertainties are being glossed over? Would a different professional reasonably disagree with this conclusion? These questions are not criticisms of the system. They are expressions of professional care. Output quality standards must be defined before outputs are relied upon. Without defined standards, review becomes subjective. One reviewer is cautious. Another is permissive. A third assumes reliability. The firm now has multiple quality thresholds without realizing it. Inconsistency again becomes the problem. Governed firms define what constitutes acceptable output in advance. They decide what level of completeness is required, what degree of corroboration is necessary, and what types of outputs require enhanced scrutiny. This does not require perfection. It requires clarity. Review standards also protect professionals from hindsight bias. When issues surface later, reviewers and regulators often judge decisions with information that was not available at the time. Clear review standards demonstrate that reasonable judgment was exercised based on what was known. That demonstration matters. It shifts the conversation from outcome-based criticism to process-based evaluation. Process is what governance controls. Outcome is what hindsight distorts. Output quality must also consider consistency. If an AI system produces materially different outputs when given similar inputs, that variability must be understood and accounted for. Unexplained inconsistency undermines trust. Professionals rely on predictability. Governance does not require identical outputs. It requires explainable variation. If variation cannot be explained, reliance must be limited. Review discipline is not about distrusting AI. It is about refusing to outsource judgment. Professional identity is rooted in judgment, not computation. AI may assist with computation. It may assist with synthesis. It may assist with drafting. It may not assume responsibility for conclusions. That boundary is enforced through review. Review is where judgment becomes visible. It is also where professionalism is demonstrated. Clients, regulators, and courts do not expect that no mistakes will occur. They expect that work was reviewed thoughtfully, not accepted automatically. A documented review process signals care. A casual acceptance signals complacency. This chapter reinforces a simple principle. An output is only as strong as the review behind it. Without review, accuracy is accidental. With review, accuracy becomes professional judgment. That judgment is what protects the firm. It is what preserves trust, and it is what ensures that AI remains a support, not a substitute, for professional responsibility. Governance assumes failure. That statement is not pessimistic. It is professional. In accounting, bookkeeping, and tax work, every serious control framework is designed around the assumption that errors will occur. Not because professionals are careless, but because complexity guarantees imperfection. Systems interact, data moves, context shifts, judgment is exercised under time pressure. Artificial intelligence does not remove this reality, it intensifies it. AI systems operate across larger volumes of data at greater speed and with less visible friction. That combination increases both opportunity and exposure. The relevant governance question is not whether failure will occur, but whether the firm has already decided how failure will be handled when it does. Most firms have not. They focus on accuracy, they focus on efficiency, they focus on time savings. Very few focus on failure handling. As a result, risk accumulates quietly. This chapter exists to make failure handling explicit, deliberate, and defensible. Data is the first point of exposure. Every AI agent operates on data, and the most important data governance decision is not what the system produces, but what the system is allowed to access. Least privilege access is a professional standard, not a technical preference. It means the system receives only the minimum data required to perform its defined purpose, and nothing more. This matters because AI systems do not understand relevance in the way professionals do. They infer patterns based on what they are given. If unnecessary data is accessible, it becomes part of the inference space even if it was never intended to influence outcomes. That creates risk that is difficult to detect. Confidential information may be incorporated implicitly. Cross-client context may influence outputs unintentionally. Assumptions may be shaped by data that should never have been visible. If an AI-influenced output is questioned later, and the firm cannot clearly explain what data the system was allowed to access, the firm is immediately on the defensive. Governance requires that data access decisions are intentional, documented, and reviewed periodically. Access that is assumed is access that cannot be defended. Exposure risk is often visible at first. One of the most dangerous characteristics of AI-related risk is that failure rarely looks dramatic. Outputs are usually plausible. They read well, they sound reasonable, they often align with expectations. That plausibility delays detection. Traditional system failures produce alerts. AI failures produce confidence. By the time a problem is discovered, the output may already have been relied upon, communicated, or embedded in work papers. Governance exists to anticipate where this exposure might arise and to limit its impact in advance. This includes defining where AI outputs may be used, where they may not be used, and when enhanced scrutiny is mandatory. It also includes deciding which outputs are never acceptable without independent verification. If exposure is not anticipated, it compounds quietly. It is important to distinguish between error and failure. An error is an incorrect or inappropriate output. A failure is a breakdown in governance. Errors are inevitable, even in well-governed systems. Failures are not. Failures occur when errors are not detected, when escalation is unclear, or when responsibility is ambiguous. The role of governance is not to eliminate error, but to prevent error from becoming failure. That distinction matters because it shifts the focus from perfection to preparedness. Escalation must be defined before it is needed. When an AI-assisted output is identified as questionable, the firm must already know what happens next. Who is notified? Who reviews the issue? Who decides whether work must be corrected, withdrawn, or reperformed? Who documents the incident? If these questions are answered only after a problem arises, governance is already late. The most common failure mode is silence. Someone notices something that feels wrong. They are unsure whether it matters. They assume someone else will address it. The output moves forward. Silence is not neutral. Silence is risk. Governed firms treat escalation as a standard operating procedure, not as an emotional reaction. Clear escalation protocols remove hesitation. They replace uncertainty with process. Failure handling also requires containment. When an AI-assisted output is deemed unreliable, the firm must know whether it can be isolated, where it has been used, and how downstream effects will be addressed. If AI outputs are copied, summarized, or reused across engagements without traceability, containment becomes impossible. That is not a technical issue. It is a governance issue. Containment planning forces discipline. It encourages limited deployment, controlled reuse, and documentation of dependencies. These controls reduce the blast radius when issues occur. Incident handling in a professional firm is not an IT function. It is a judgment function. How an issue is handled matters as much as the issue itself. Clients, regulators, and reviewers do not expect perfection. They expect foresight, transparency, and competence under pressure. A firm that can demonstrate predefined escalation, documented response, and corrective action appears controlled, even when something goes wrong. A firm that improvises appears careless, even if the underlying mistake was minor. Preparedness signals professionalism. Documentation plays a central role in failure handling. The purpose of documentation is not blame, it is explanation. Well-governed firms can reconstruct what the system did, what data it accessed, who reviewed the output when the issue was identified, and how it was resolved. That ability to reconstruct events is often the difference between discomfort and exposure. Firms that plan for failure recover faster. They detect issues earlier. They contain them more effectively. They preserve trust more easily. Preparedness does not slow innovation. It allows innovation to survive scrutiny. This chapter reinforces a fundamental principle. AI does not change the professional obligation to anticipate risk. It amplifies it. In professional services, growth without discipline is not progress. It is exposure multiplied. This chapter exists because AI risk does not usually emerge at the moment of first adoption. It emerges when usage expands faster than governance can support. For accountants, bookkeepers, and tax consultants, scaling AI is not a technical exercise. It is a professional judgment exercise. The question is not whether an AI-assisted process works in isolation. The question is whether it can be repeated, supervised, and explained across engagements without degrading standards. Most firms begin cautiously. A system is tested on a small set of files. Results appear acceptable. Time is saved. Confidence increases. Expansion follows. What often does not follow is a proportional expansion of oversight. That gap is where risk accumulates. Scaling magnifies whatever governance exists. If standards are weak, scaling amplifies weakness. If review is informal, scaling institutionalizes informality. Discipline must therefore precede expansion. Replication should come before scale. Replication means the firm can demonstrate that an AI-assisted process produces consistent, explainable outcomes under controlled conditions. It means the firm understands where the system performs reliably, where it struggles, and where professional judgment must intervene. Without replication, scaling is guesswork. Guesswork is not defensible. In accounting and tax work, consistency matters. Clients expect similar treatment under similar circumstances. Regulators expect uniform application of standards. Reviewers expect predictability. If an AI system produces materially different results across engagements without clear explanation, reliance must be limited. Variability without explanation undermines trust. Scaling also tests oversight capacity. Every AI-assisted process requires review, supervision, and accountability. As usage expands, so does the demand on those functions. If review capacity does not scale with usage, governance collapses quietly. Outputs move faster than review. Judgment becomes cursory. Issues are missed. This is not a failure of intention. It is a failure of capacity planning. Firms often underestimate how much oversight AI requires at scale because individual outputs appear efficient. Efficiency at the task level can mask overload at the governance level. Professional firms must therefore ask a difficult question before scaling. Do we have the capacity to review, supervise, and explain this process at the volume we are proposing? If the answer is uncertain, expansion should pause. Pausing is not resistance, it is control. Scaling also increases organizational distance. As AI-assisted processes are adopted across teams, offices, or service lines, the people responsible for governance become further removed from day-to-day use. That distance increases the risk that standards will be interpreted differently. Local adaptations emerge, shortcuts are rationalized, exceptions become routine. Without active reinforcement, standards erode. Discipline scaling requires more than documentation. It requires reinforcement through training, supervision, and leadership attention. Standards must be visible, not buried. This is particularly important in tax practices, where timing pressure is intense. During peak periods, the temptation to rely more heavily on AI assistance increases. Governance must be strongest when pressure is highest. If standards collapse under stress, they were never real. Disciplined firms plan for this. They anticipate seasonal pressure. They reinforce review expectations. They narrow permissible use rather than broaden it. That restraint is a sign of maturity. Another risk of uncontrolled scaling is mission creep. A system introduced for a narrow purpose begins to influence adjacent tasks. Because the system appears competent, its role expands informally. What was once an assistant becomes a default reference. That shift is rarely documented. It is noticed only when someone asks, years later, why a particular approach became standard. If no one can answer that question clearly, governance failed at scale. Disciplined scaling requires periodic reassessment. Firms must revisit whether the system's original purpose remains appropriate, whether boundaries are still being respected, and whether review standards remain effective. Scaling is not a one-time decision. It is an ongoing commitment. This chapter reinforces a central truth. AI does not reduce the need for professional supervision. It increases it. The more widely a system is used, the more important governance becomes. Firms that scale with discipline protect their standards as they grow. Firms that scale without discipline institutionalize risk. In professional services, reputation is cumulative. It is built through consistent judgment over time. Disciplined scaling preserves that consistency. Without it, efficiency gains are temporary and exposure is permanent. In professional services, how AI is measured and how it is communicated matters as much as how it is governed. This chapter exists because many firms undermine their own credibility, not through misuse of AI, but through overstatement. Measurement without discipline becomes marketing. Communication without restraint becomes misrepresentation. Neither belongs in a professional practice. For accountants, bookkeepers, and tax consultants, AI value must be evaluated through a professional lens, not a technological one. The first mistake firms make is measuring the wrong thing. Time savings are easy to measure. Output volume is easy to measure. Speed is easy to measure. None of those metrics capture professional risk. A process that is faster but less defensible is not an improvement. A system that produces more output but increases exposure is not a gain. Professional measurement must therefore ask different questions. Does this system preserve judgment? Does it improve consistency? Does it reduce rework? Does it support audit reconstruction? These are not glamorous metrics, but they are meaningful ones. They align with professional obligations rather than operational convenience. Measurement must also be realistic. AI does not perform uniformly across all engagements. It performs well in some contexts and poorly in others. Aggregated metrics can hide that variability. If a firm measures only average performance, it misses where risk concentrates. Governed firms look for outliers. They examine where outputs required correction. They track where additional review was necessary. They notice where reliance was inappropriate. Those observations inform governance decisions. They are signals, not failures. Measurement is not about proving success. It is about maintaining control. Communication introduces a separate but equally important risk. How AI use is described, internally and externally, shapes expectations. Overconfident communication creates pressure. Pressure encourages reliance. Reliance without review leads to exposure. This is particularly relevant when communicating with clients. Clients do not need to know every tool used in the background. They do need to trust that professional judgment governs outcomes. When firms emphasize AI capabilities too aggressively, they risk implying that decisions are automated rather than considered. That implication undermines the very trust professional services depend on. Professional communication must therefore be factual, restrained, and accurate. AI should be described as a support to professional work, not a substitute for expertise. This applies equally to marketing materials, proposals, internal training, and casual conversations. Consistency matters. If one part of the firm describes AI as advisory and another describes it as authoritative, confusion follows. Confusion erodes trust. Communication discipline also protects professionals internally. When leadership speaks carefully about AI, it signals that judgment is still expected. When leadership speaks in superlatives, it creates implicit pressure to rely more heavily on systems. That pressure may not be explicit, but it is felt. Governance must therefore extend to language. What is said publicly shapes how AI is used privately. Measurement and communication converge in one critical area: regulatory scrutiny. When practices are reviewed, regulators and reviewers look not only at what was done, but at how it was framed. A firm that presents AI as a tool governed by standards appears controlled. A firm that presents AI as a differentiator that handles work appears exposed. Tone matters. Restraint signals professionalism. This chapter reinforces a central principle. Credibility is preserved not by exaggerating capability, but by demonstrating control. Firms that measure AI thoughtfully and communicate it carefully maintain trust even as tools evolve. Those that chase perception risk losing substance. In professional services, reputation is built quietly and lost quickly. Measurement and communication are not afterthoughts. They are governance functions. When handled with discipline, they reinforce the message that AI is present, controlled, and subordinate to professional judgment. That message is what clients, regulators, and reviewers ultimately rely on. Artificial intelligence will continue to evolve. New tools will appear. Capabilities will expand. Efficiency claims will grow louder. None of that changes the nature of professional responsibility. For accountants, bookkeepers, and tax consultants, trust is not built on speed or novelty. It is built on judgment. Throughout this briefing, the emphasis has not been on how to use AI, but on how to govern its influence. That distinction matters. Tools change constantly. Standards do not. Professional firms are not technology companies. Your value does not come from adopting tools early. It comes from exercising judgment consistently, defensively, and calmly, even as technology evolves. AI does not remove that obligation. It intensifies it. When AI is introduced without governance, judgment becomes implicit instead of explicit. Responsibility becomes diffuse instead of assigned. Decisions become harder to reconstruct instead of easier to explain. Those conditions do not fail loudly. They fail quietly. By the time concerns surface, the firm is often forced into explanation rather than demonstration. Explanation after the fact is always weaker than governance in advance. This briefing has emphasized one central idea. AI may assist professional work, but it must never replace professional responsibility. Responsibility belongs to people. It belongs to those who sign off on work, answer questions, and stand behind outcomes. Governance exists to preserve that responsibility in a changing environment. It provides clarity when systems become complex. It provides restraint when capability expands. It provides confidence when scrutiny arrives. Firms that establish standards before automation are not resisting innovation, they are leading it. They understand that discipline is not a constraint on progress. It is the condition that allows progress to endure. For accountants, bookkeepers, and tax consultants, the long-term risk is not falling behind technologically. The risk is losing clarity about who is responsible for what and why. When that clarity erodes, trust erodes with it. The purpose of governance is not to slow work. It is to ensure that work remains defensible, explainable, and professional, regardless of the tools involved. AI will continue to change. Expectations will continue to rise. Scrutiny will not diminish. Firms that rely on informal practices will find themselves constantly adapting, reacting, and justifying. Firms that rely on standards will remain steady. They will be able to explain their decisions calmly. They will be able to demonstrate control without defensiveness. They will be able to integrate new tools without compromising judgment. That is the advantage of governance. Not efficiency, not novelty, stability. Professional credibility is built over years and tested in moments. This briefing is about preparing for those moments before they arrive. By establishing purpose, boundaries, decision standards, review discipline, failure handling, and communication restraint, you ensure that AI remains what it should be: a support, not an authority. Tools will come and go, standards endure. Standards come before automation. If you want to formalize these principles inside your firm, I've prepared a practical checklist, a deeper reference guide, and a full implementation course. You'll find the links below. Use them when you're ready.